Good morning, good afternoon, good evening. It's Friday, February 16, 8:32 a.m. And welcome to our latest episode. This is Mark Yu.
And this is Wawi 100 today.
100 episode. And coincidentally, S&P 500 has reached the hallmark 5,000 points. So that's our title. Hello, 5,000. How are you, Wawi?
I'm doing fine, Mark. How are you doing, man?
Good, good, good. Would you believe that Would you believe that we already reached 5,000, the level that most analysts are projecting for the end of this year to be met? We've met in like 1.5 months. Today's February 16th. So, how about that?
Yes, it was unexpected, I guess, for the most part. But now that we reached that point, I am very optimistic in the way the market is moving.
Mhm.
So I won't be surprised if it goes higher than this.
I am too. Speaking of optimism, we here we're not registered financial planners or anything like that, so don't consider our thoughts being shared here as investment advice. But we do take this seriously, and we put our hard-earned money investing in stock market. Speaking of optimism, going back to that, we're going to take a look at the weekly sentiments of investors in the stock market, whether they think it will still go up or down. But look at that chart. Incredible. 5,000 points. I think this was the shortest period in history that the S&P has climbed that fast. 1,000 point gain since let's see, April of last year. So that's another record there, guys. So this is a article last week indicating about the momentum that the stock market is doing. Leaves the dip buyers without a playbook. The stocks prior to this week, actually, we dipped quite a bit after the inflation surprised us, indicating that the Federal Reserve might still hold on to the rates. But yeah, S&P was up 14 now out of the past 16 weeks, the best run since 1972. So it's hard to get in the ride. It's gonna produce some FOMO if people are still
Mhm.
on cash, which they are. Most of people are, depending on their current situation. There's actually we're gonna take a closer look in the fund flows too, where the money is headed, or if they have exited, or are they still flowing in to the money market funds. According to this analyst here, big segments of the market are still very expensive. Look at that. His fund holds 12% of his money in cash. It's possible that a recession gives me an opportunity to put it to work at better prices. So everybody's looking at the some sort of a recession early this year prior to summer. So I don't know, what if that doesn't happen and there's a lot more FOMO behind the market rally. So I don't know. He's already timing the market as a fund manager. Um, so that's quite interesting to see. Number of up days in any 15-week stretch, we're kind of like topping up peak since 2019 prior to the pandemic. Um, so next slide here. So here we go. This was just published a couple of days ago. CPI data, inflation data. It slams momentum slams into a wall in S&P 500, worst CPI data in years. So, do you recall the number that was given here, Wowie? How much we
I think it was like 0.8%. I'm not sure, but the market reacted negatively for that day and then rebounded on Valentine's Day significantly.
Yeah, day after, it's as if
Mhm.
nothing happened. But there was no news, no Federal Reserve saying that, oh, we're still gonna cut rate, nothing like that. But yeah, the market recovered even yesterday, back to 5,000 points.
So this kind of very cautious, the sentiment is cautious and opportunistic.
Mhm. So yes, stocks S&P 500s are still hitting fresh 3-month lows, but remains well off October peak. In terms of market breadth, what we're gonna see here, it says here some 51% of stocks in S&P 500, or a little more than half, are trading still above their 50-day moving average. This is the fewest since November. So a little bit of contrarian indicator there. So this is a quote from Chief Investment Strategist. Market participants had been conditioned to expect a linear decline in inflation. They were hoping numbers would cooperate with a glide path toward 2%, leading to the rate cuts that the market had priced in. So right now we kind of have experienced some sort of a gyration in the reaction of Wall Street. But right now everything looks bullish. So that was a chart. This is a chart that was reported. Quite an upside there. Like you're right, Wawi, 0.8, the highest reading since September of last year. So quite a jump there. So I don't know. CME Fed Watch Tool is a good indicator to take a look at this point, just to see where, obviously in March, there's still 8.5%, hoping that there'll be a cut. So that was compared to 16%. So slowly people are jumping on the steady or no cut scenario from last week after this uh, CPI red hot inflation report. In May, 68% thinks that though there won't be any cuts. That was from 39% a week ago. So definitely a turn situation here. If you guys remember, me and Wawi take a look at this early this year, and already in May, previously, there wasn't even a 525, 550 here. People already thought that the Federal Reserve will be cutting rates at May. It will be second or third already. So slowly the tide is turning. Looks like the rate is going to stay high. And even on May, people are anticipating that the rates will be changing. So that's 5 months into the year. And then even in June, people are thinking that there is still 30%. 30% thinks that the market rate would be still the same on June of this year from 7.8% last week. So being a little bit more conservative now, guys. So let's see how the sentiments are in terms of these findings. So American Association of Individual Investors, what the stock market will be in the next 6 months. Yep, quite a dip in sentiments, bullish from 49% last week to 42% as of Valentine's Day, from 22.6 bearish to 26.8. So a little bit of climb, 3% increase in neutral as well, from 28 to 31%. So people are kind of pulling back their optimism for new rate cuts anytime soon. Um, and this is another sentiment reader here, the Fear and Greed Index. So look at that. We're still at 78. Extreme greed at this point compared to 77 a week ago. So maybe a laggard in terms of sentiment. What do you think, Wowie?
Yeah, it fluctuates. So, depending on the data and the news that's coming out.
Mm,
Right now, it's a pullback today, even though next Monday's closed market day because
mm,
of President's Day.
mm-hmm.
People are pulling back today. As you can see, S&P 500 is down, but it's still above 5,000. It's 5,020 right now.
Wow. That's good. Holding at the 5,000 barrier. Would you believe
hmm
that Some of the analysts were forecasting 3,000 late last year. 3,000 for the S&P. That's 2,000 point difference at this point. So for those who have believed that would have been left in the dust and parked their money in the money market funds at this point.
And those that have dollar cost average throughout the uncertainty are probably reaping some rewards right now.
Definitely, yes. Averaging high, the market momentum gauge. Look at that. S&P 500 at its widest difference compared to its 125-day moving average, indicating a strong market momentum. So in contrary to the report here by Bloomberg that the momentum has gotten slammed, nope, I don't think so because S&P closed 5,029 points yesterday compared to the 125-day, its highest for the past year. Stock price strength, this was highlighted a couple of recordings that we did ago. It's U-turning. So there's some support, not just the big stocks that are supporting this recovery. Even the McClellan volume submission index had quite an uptick as of yesterday. It went up. So there's a lot of stocks that are kind of bouncing and supporting this uptrend in the S&P 500 reaching the 5,000 points. The put and call options have been trending down, meaning that there are less people making bets that the market would go down despite the increase in bearishness. The volatility, it's up. So this is what we had highlighted earlier. There's some volatility happening. It's above its 50-day moving average for the past week, but not quite troublesome as we have witnessed between September and October of last year. So let's take a look at the fund flows. Where is the money flowing? So this was published just this morning, 5:54 a.m. Red hot from the oven. Thank you so much, Reuters, for this free data. Global equity funds see big inflows amid stock rally. So a lot of money has flown in to stock market for the past week globally. So this has been propelled, according to the article, by investor optimism amid a robust stock market rally, despite lingering uncertainties over Federal Reserve rate cut plans. According to the data, investors purchased 9.12 billion worth of global stocks this week, marking the largest weekly purchase since December of last year. So quite a good amount of flowing into the market. Oh, look at that. Money market. Let's take a look at this money market. That's a big down. 40 plus billion came out of the money market. Looks like people are finally putting their money into stocks at this point.
Putting it to work now.
Yeah. MSCI. Speaking of MSCI, I'm not sure if you've seen the news that MSCI, sidetrack a bit here, are removing a lot of Chinese companies from the MSCI China index.
Hmm.
66 big companies are going to be taken off MSCI. So that means that the China exposure of MSCI would shrink. And I've seen reports that they're projecting that India, after hitting a lot of all-time highs last year, would now be more exposed, or investors will be now more exposed in India compared to China.
Hmm.
But yeah, that's another topic for us to discuss. But it says here US stocks 6.78. So a lot of money, more than two-thirds, obviously, went into US stocks. Biggest inflow in 7 weeks. 1.7 billion flown into Asian funds. A lot of people still sold European stocks. 151 million, not with a B, but with an M. So not a whole lot of movement, not a whole lot of love in European. Oh, speaking of European, well, I guess UK has Brexit. They have exited the European, but UK actually dipped into recession as of this week. The FTSE, though, its index, the 100 largest UK index, hit its 1 year high at the same time. So I know how that correlates. Also, Japan hit recession this week, and their index is 1.1% away from a new all-time high since 1989. So what are your thoughts on that? Wowie? How in the world is that possible?
Well, they have a very lax monetary policy and they're sticking with that game plan, and that's still pushing the market.
Yeah, incredibly. Yeah, I'm so amazed. Well, the Japanese yen hit a new low, I think, more than 150 yen per dollar. Maybe that helps.
Well, being at one time the second largest economy,
Right.
um, I always look at it, that Japan and US has to balance each other out. If US is tightening, Japan is loosening.
Mm-hmm.
They kind of balance each other out. But now we're in kind of like a transition phase of the, China plus one or two, we're
Yeah.
looking for more suppliers all over the world because we're the main consumer of the world.
Mm-hmm.
So that that yin yang has changed. We have more yings around there right now
Right.
to
Well,
balance the market. South America, Vietnam,
mhm.
India.
Speaking of consumerism, I think we came out with US came out with a report yesterday that kind of didn't meet expectations. Consumer dipped, I think
Hmm.
negative 0.8%, quite a dip compared to expectations. So a
Hmm.
little bit of a slowdown. Some analysts are saying that it's because of the weather or the winter
Yeah,
weather.
the manufacturing PPI I think was slowed down. Oh no, no, the manufacturing index has slowed down. They're
Mm.
saying it's the winter,
Right,
but that's kind of what you call questionable. But more important for me is that consumers are not buying as much.
right.
That tells you that people are trying to pull back on their expenses because of higher prices. But food prices have gone down, so that's good. But the only thing that's still tenable because the cost of goods being uh, shipped is gonna go up because they're avoiding the the Houthi rebels along the Red Sea. So it takes them 9 to 10 days now to get products to the US.
And that can affect further possibly the inflation story.
Mm-hmm.
So that's kind of critical there. It might
Yes, yes,
hammer
it
hard.
is.
Mhm.
It's still inflationary, the risk that's going on, the geopolitical situation.
Right. Okay, going back to the fund flows, bit of a segue there. So 2.66 billion flowed into tech, fifth consecutive week of buying. Industrials and consumer discretionary also drew in 277 and 240 million, respectively. But a lot of money I've trying to catch that train in the tech world. Fund flows, $266 billion. Bond funds, we have been closely observing, also drew in 11.25 billion in purchases, extending inflows into its second consecutive month. So a lot of money is flowing into bond funds for some reason, trying to probably hold on to those fixed rates for the long term because in anticipation that the Fed will cut rates pretty soon. But I don't think that's happening. So a lot of money now are getting stuck on these bond funds, thinking that they won't be able to see better rates anytime soon. But yeah, lo and behold, the market shocks us in all sorts of fashion, despite all of this knowledge data that we have. Corporate bond funds drew in 2.4 billion, biggest inflow in a month. Government and loan participation 1.7 billion and 46.7 million, respectively. Here we go. Investors offloaded 41.48 billion worth of money market funds after 2 weeks of net buying. Even commodities saw withdrawals of 650 million from precious metals. Energy some saw a little bit of selling, 77 million. So energy has not been that quite of a fantastic investment so far this year, which we're gonna take a closer look in a second. Uh, Emerging markets received 382 million, its first weekly inflow in 5 weeks. Emerging bond funds are not as attractive as here in the US. Emerging bond funds saw 85 million selling. So that's good for the Reuters. So Bank of America was pub data flow was also published by Reuters as of this morning. Here we go. Investors dumped cash and continued to pour money into equities, particularly tech stocks and bond funds as of Wednesday. So it's the same thing as we have just discussed. 16 billion flown into stocks, 11 billion to the bonds, 18 billion outflow from cash, the most in 8 weeks. So quite a trailing finding there that money is now trying to catch up to tech. Past week performance, financials. I wasn't looking forward to financials being the best performing stock for the past 5 days. Utilities as well. Wow. And then consumers, cyclical. Worst performing sectors, defensive, communication services, and technology. Oh, even energy is positive, even better performing than technology. So quite a finding here.
Hmm. I think they're trying to move in early
Mm.
before the rate are lowered.
Right. And since the start of the year, technology is the best performing sector. That kind of supports our thesis that investors are feeling some FOMO right now, especially when you see Nvidia skyrocketing every day and super micro devices, companies I haven't heard before, more than tripling in the past year. That's
Well,
crazy.
some of these small companies are being bought by Nvidia,
Oh yeah.
and
Hmm.
it's driving their prices up to the ceiling because Nvidia is investing in them. Nvidia has bought some chip companies, ARM Holdings, and even a biotech company.
I saw that. Even too simple. The one that's rolling their
Yes.
company back. I think they're trying to shut down their US operations, but Nvidia bought about 3 million thing of stock. So this
Yeah,
is
and now I'm
okay.
stuck with Aurora.
Is that a chip maker too?
No, it's another truck company that's automated.
Oh,
They
all right.
spiked when Too Simple moved to China.
Mhm. Oh, all right. Before we go to Wawi's take for the week. Just one more sentiment indicator here. New sentiment data. Looks like this was as of February 11 of this week. It dipped quite a little bit. If I can zoom out and show you guys the chart. So new sentiment is not all that hot for the stock market. I kind of dipped quite a bit in the past week. So what does this mean? Just means that we're barely neutral in terms of being positive news articles being written regarding the stock market. I think the recent CPI data kind of like influenced that a lot. So, Wally, let's jump into your picks. You told me about American Tower Corporation. What attracts you to this company?
Well, they are a global company and they provide the towers for your cell phones. And they act as a real estate investment trust. And
Okay.
it provides good dividends.
So its performance for the year so far is down 13.5%. Its market cap is $88 billion. Dividend is 3.59%. Let's take a look at its peers, its competitors. Crown Castle is 46 billion. Oh, so American Tower is one of the largest, Huawei. Crown Castle is
Yes.
half of it. Oh, Equinix data center. So it's not a, I don't think it should be compared to Equinix because it's a data center. This is a telecom tower. If not, it's the largest telecom tower in the world. $88 billion. Let's take a look at its performance. Yeah, it's down 13%. Crown Castle down 7% for the year. SBAC, I don't know what SBAC stands for. SBA Communications down 18%. So most of the peers are down as well. Let's look at its financials. Um, Revenue has been increasing. Yeah. 2019 before the pandemic, 7.46 billion. And as of 2022, 10.47 billion. So business is growing. That's pretty good sign. Profits have been stable. 1.8 billion 3 years ago in 2022, 1.76 billion. And the thing about REITs is like sometimes they have a lot of debt. So we'll just take a look at its debt as of its latest report. Oh, it had 2.1 billion in cash and about, hopefully we can get a summarize. Oh, 46 billion in debt. So a lot of debt on the overhanging on the company, but its business is growing. So that's one thing, one indicator there. Besides, if the Federal Reserve will keep the rates level for the next six, 2 quarters, I think they'll be fine. It's pretty relatively steady for American Tower. So next was Realty Income Corporation. What attracts you to this company, Wawi?
It's a dividend king. It's another REIT
Oh, okay.
that I think has suffered, some correction on its price, but it's another large REIT company that I think
Definitely.
somebody needs to hold in their portfolio.
Hmm. So yeah, you're right. So it's on the correction mode for the start of the year. It's down close to 11%. Its size is 37.75 billion, a little smaller, 30 billion less compared to American Tower. Forward price ratio, I don't see it here. So let's just see in its peers, its competitors. Simon Property, another retail REIT, 55 billion. Imco, a little smaller, 13 billion. So you can get quite a range here. You either as the biggest one or the smaller or the one in the middle, which is Realty Income. For the year, like we said, it's down 10%. Simon Properties, I think Simon is more in the malls too, right? I
Mm-hmm.
see a lot of Simon Properties in when you go to the premium outlet stores. Simon Property is up 4%. It's the only REIT that's up among this batch here. Kimco is down 8%. REG or Regency is down 9%. So looking at the financials of Realty Income, so it's definitely really growing. 2019, 1.48 billion. 2022, it more than doubled, $3.3 billion. So that's a good sign that you want to see in businesses. They're growing continuously in their top line. Bottom line, it also doubled. 436 million 2019, 869 million in 2022. So pretty solid there in growing its profitability, which is impressive. Um, let's see its balance sheet. Cash is only 344 million, and its long-term debt is around $20 billion. So that's a lot of debt. So that's a lot of balance that Realty is doing. Let's see its interest payments on a yearly basis out of its profitability. I'm not seeing it though. Interest expense. It's spending nearly half a billion, 465 million in 2022. But despite that, it still profited 870 million. So that's a lot of expense to be paid, but looks like the company is really good at balancing stuff. I don't see, maybe it's taking on debt too. So let's take a closer look at the financing part on its cash flow. Yeah, on a yearly basis, they've been taking a lot more debt. So that's a little bit of a troubling sign. I guess their business is really strong, so banks are open to them, lending more money. So in 2019, they only issued 3.7 billion in debt, but that has more than 10 times as of 2022, 30 billion in debt. So from financing, they've been getting a lot more money from financing to finance their operations and more likely their dividend payouts too. So just a heads up there. The last highlight from Wawi's selections, TFC, Truist Financial Corporation. What attracted you to this one, Wawi?
Well, if things move into a lower rate environment, I think Truist is one of those regional banks financing system that's ready to take on, the surge in demand
Mhm.
for debt and loans.
True.
I think it's well positioned.
hmm I'm looking at its performance for the year. It's just down negative 1.8%. As we have highlighted for the past week, financials actually were the best performing, if not, let's see. Yeah, it's the best performing sector for the past week, financials and then utilities. So it's holding up there. Its dividend is 5.7%, which is pretty good. Market cap, $48 billion. Let's take a look at its peers. M&T Bank Corporation at 22 billion, Huntington Bank shares 18 billion. So it's, if not, it's one of the largest. Is it a regional bank? Yeah. So regional banks are kind of in the news recently because of their
Yes, exposure to the commercial real estate.
yeah, the real estate the drama that's unfolding right now before our eyes. Oh, actually, CBRE came out with this report yesterday, which I was wanting to share in a little bit. They're saying that the office industry, real estate, uh, trouble is close to being over. So I have a slide here discussing that shortly. For this, since the start of the year, TFC is down 1.7, M&T flat 0.47, Huntington 1.49. Um, Looking at the financials for TFC, yep, it's more than doubled too. Revenue, net interest income. Well, let's take a revenue. So from 11 billion back in 2019, it's 21 billion now, 20 December 2023. So that's a good sign. It's profitability. Oh, actually delivered profit loss 2023. That's quite interesting. I don't know why. Oh, it registered a 6 billion impairment, which erased its earnings before taxes for last year. So that's a little bit of a red flag there. I'm not sure where that came from, but they've surely written off a lot of value, a lot of their income to loss, delivering them to a loss last year. So I would personally be a little bit skeptical on this kind of like reporting, especially its one-time hit. Now that we are entering a little bit of troublesome period for the sector, the regional banks. So, oh, here we go. So, we're now we're skipping into the retail sales drop, which we have already discussed. So it dropped 0.8% compared to a forecast of 0.1%. So that's big of a dip right there, like meanwhile we have discussed. So here we go. CBRE shares soar after signaling worst is over for US office market. Would you believe that? Let's see what its stock is doing before market. Or right now the market is open. Huh, even though with that announcement, their share price is flat. So Wall Street is not impressed of this claim by CBRE last night. Its revenue increase, its profit also increase. 503% for its profit. Wow. So let's take a look at their quote. Even though 2023 was a difficult year for commercial real estate, we delivered the third highest full year earnings in CBRE history as our resilient businesses continued their strong growth. Wow. I don't know where they see the sales revenue declines were less pronounced in industrial and retail than multifamily. So multi and family and office apartments and offices are still being seen as red ink at this point. What what did they mean by over? I think they mentioned there we go. This is the quote. No, that one. So I guess I can't find the quote that they're saying it's over. But
Oh,
that was on a article here signaling worst is over.
well, that means a rotation back into office work, which
Mhm.
I think is going to be a trend because we're post pandemic and people are going back to work. There's still remote work and it's here to stay. We have more of hybrid work, which is similar to what my son is going to do now. He's been remote working for about the past 2 years, and now
Mm.
he's taking a job hybrid. So there's the trend.
Yeah, people getting back to offices and remote works. Remote office job has been slowly declining. Yeah, I still can't find the quote there. I think this is kind of misleading article title. But so regional banks, who are the largest exposed? So we're down to our last minute here. So just a brief highlights: Valley National Bank, Flagstar Bank, New York Community Bank, Axos Bank, Washington Federal Bank, WAFD, Axos Financial, Bank OZK, Umpqua, Columbia Banking System, City National Bank of Florida. So these are the companies that are really exposed to the real estate market, office market, and apartments. So I guess that does it for our latest 100 episode. We made it, Wawi.
We made it to 100 episode.
And more.
Congratulations to everyone that's been watching.
Thank you,
Please
guys.
like and subscribe. Follow us. We'll
Congratulations,
keep
Wawi.
it interesting. Congratulations, Mark.
Thank you, guys. So I guess that'll do it. Stay safe and have a good weekend. Thank you, Wawi, for joining us.
Thank you,
Again
Mark.
next week.